Welcome to this lecture on External Audit Perspectives on Internal Controls. In this session, we'll explore how external auditors evaluate an organization's internal control systems, what they look for during an audit, and how their perspectives differ from internal audit and management roles. External auditors play a crucial role in providing independent assurance to stakeholders, such as investors, regulators, and boards of directors, that financial statements are accurate and reliable. To achieve this, they assess whether the organization's internal controls are designed and operating effectively to prevent or detect material misstatements. Let's begin by understanding the objective of external auditors. Their primary goal is to express an opinion on the fairness of financial statements. However, because internal controls directly influence the reliability of financial data, evaluating them is an essential part of the audit process. External auditors follow established standards such as the International Standards on Auditing, ISA 315 and 330, or the Public Company Accounting Oversight Board, PCAOB standards in the U.S., which require them to understand and assess internal control systems to design effective audit procedures. The evaluation process generally involves 4 stages: understanding, assessing, testing, and reporting. Stage 1. Understanding internal controls. Auditors start by gaining a thorough understanding of the organization's control environment, risk assessment processes, and key controls related to financial reporting. This involves reviewing documentation, interviewing personnel, and observing processes. The goal is to identify areas where misstatements could occur and determine which controls mitigate those risks. For example, auditors may study how management approves journal entries, reconciles bank accounts, or manages system access to ensure segregation of duties. Stage 2. Assessing control risk. Next, auditors assess the likelihood that controls will fail to prevent or detect material misstatements, known as control risk. They evaluate the design and implementation of key controls to determine whether they can be relied upon. If auditors conclude that controls are strong, they may reduce the amount of detailed substantive testing. If controls appear weak, more extensive testing of transactions and balances is required. Stage 3. Testing control effectiveness. Auditors test controls to verify whether they are operating effectively. This includes sampling transactions, inspecting documentation, and reperforming control activities. For instance, auditors might test whether approvals were consistently obtained for high-value purchases or whether reconciliations were performed on time. When deficiencies are found, auditors assess their significance. They categorize them as control deficiencies, significant deficiencies, or material weaknesses, similar to internal audit terminology. A material weakness indicates that there is a reasonable possibility of a material misstatement not being prevented or detected in time. Stage 4. Reporting findings. Finally, auditors communicate their findings to management and those charged with governance, such as the audit committee. If material weaknesses or significant deficiencies are identified, auditors are required to report them formally. For public companies under the Sarbanes-Oxley Act, SOX, these deficiencies must also be disclosed in management's internal control report. External auditors also issue recommendations for improvement. While they maintain independence and cannot design controls, their observations often help management strengthen processes, enhance documentation, and improve compliance. It's important to note the difference between internal and external audit perspectives. Internal auditors are part of the organization and focus on ongoing assurance, risk management, and operational efficiency. External auditors, however, provide an independent third-party opinion primarily focused on financial reporting accuracy. Both functions are complementary. Strong collaboration between internal and external auditors improves audit efficiency and reduces duplication of effort. Let's look at a practical example. Suppose an external audit of a manufacturing company identifies a material weakness in inventory valuation due to poor segregation of duties and inadequate system controls. Management responds by redesigning the approval process, implementing system-based restrictions, and enhancing documentation. In the next audit cycle, the auditors test the new controls and confirm their effectiveness, allowing the company to remove the reported weakness. This example highlights how external audits not only detect issues, but also drive meaningful improvement. External auditors also rely heavily on IT general controls and automated controls within ERP systems. If system controls are reliable, auditors can place greater reliance on system-generated reports and reduce manual testing. Conversely, if IT controls are weak, auditors must perform additional procedures to verify data accuracy. Regulators and oversight bodies emphasize the importance of auditor independence and professional skepticism. External auditors must evaluate management representations critically and corroborate them with objective evidence. This independent verification underpins trust in financial reporting. To summarize, external auditors evaluate internal controls to determine whether they can rely on them when forming an opinion on financial statements. Their process involves understanding, assessing, testing, and reporting, all guided by professional standards. Through their independent lens, external auditors enhance transparency, accountability, and investor confidence. In our next lecture, we'll explore internal control in a global environment, examining how organizations operate effective control systems across diverse regions, cultures, and regulatory frameworks. Thank you for joining me in this session on External Audit Perspectives on Internal Controls.